a lot of noise was there around unlimited borrowing capacities and all. And I personally don't believe there is something called unlimited borrowing capacity. It's responsible borrowing is also important. Lenders have that duty of responsible lending. Us have the best interest duty of the client to make sure the client is not getting into trouble because of this lending. But it's very important for people to understand responsible borrowing. And there is nothing called unlimited borrowing capacity. If I am borrowing the money through a company or a trust, I'm still responsible for that debt.
Certainly.
Right? And there is an asset attached to it.
Yes.
And people want to acquire more and more. However, they need to think, how's the cash flow? Can they sustain it?
Welcome back to episode 4 of Building Generational Wealth with Strategic Property Investment. I'm your co-host, George Churchin. I'm joined here by my fellow co-host, Sandeep Jagtap. Welcome, Sandeep.
Hey, George, how are you, mate?
Very well. How are you?
Good, mate. Good. Looking forward to a nice Christmas break.
Absolutely, Sandeep. It's actually my favorite time of year, not just because of Christmas, but it's a time of year where most people, myself, yourself included, we take stock, we do our goal setting for the year ahead, we have a look at what's happened and what's transpired. So there's no time like the end of year to do that, recalibrate, and then get ready for the year ahead.
Yeah, I agree with you, George. And look, how I do my planning is review things twice a year, once around the end of calendar year, which is the Christmas break, and once at the end of June, when it's the end of financial year. So, a checkpoint midway through the financial year is a good way to understand whether we are on track or not.
Certainly agree. And that's a very good approach. My approach is very similar, to be honest. So especially when it comes to end of year, it's a good time to sit down, take stock of what's happened, right? So we've had our goals for the year, for 2025. We've been trying to work towards those. There have been checkpoints along the way, but now we have a look and see what's worked, what hasn't, what do we need to adjust, what do we need to recalibrate, and then importantly, set our goals, both sort of major and minor, for 2026. So, and I guess there's no better way to kick that off in terms of the goal setting for the new year than sort of reviewing what's happened over 2025.
Yeah, and this is that time of the year when things are a bit quiet.
Yes.
And most of the people would have probably a couple of weeks off.
Yes.
Where they can choose to travel, but even while traveling or anything, they can have that time to sit back with a pen and paper and just make sure they revisit the plan and see whether it's working or not. It's no point going into June and then realize that, whatever we planned last June for the 1st of July hasn't really got to plan. So if this is the time when we need to recalibrate, I think that's a good point and good time to do it.
Absolutely.
I agree with you.
Definitely. It certainly is. And I think, when we look at what we want to achieve, the starting point probably should be what's happened so far, right? So has everything gone to plan?
But before we go any further, George, I just want to mention most important thing, the disclaimer. Anything we talk on this podcast is not financial advice.
Absolutely.
It is general discussion and general thoughts we share. If anyone wants to sit down with us and look for a strategy for themselves, we are more than open to sit down with them and discuss their strategy with them, rather than thinking this is financial advice on this podcast. So yes, George, sorry to cut you off there, but yep, let's go and let's get started.
Fantastic, Sandeep. So I guess firstly, we want to take stock of what's happened, right? So we want to understand, have things gone to plan to start with? So initially, we want to have a review of our employment position. So we want to understand, is our business, if we're self-employed, is that on track? Are we meeting the goals of the business financially? Is it performing as we expected? So we want to understand all of that side. If we're a PAYG employee, are we sort of earning the amount of money that we expected we would? From a bonus perspective, is that coming through? Is it not? And just being mindful of these changes, right? So we want to make sure that ultimately it's the finances that will dictate what we invest in, when we invest, and how far we can go. So we want to ensure that that's well calibrated as well.
Yeah, I agree with you, George. And look, as you mentioned, with the PAYG and even if with the self-employed individuals, it's really important to sit down with your numbers and see how you are tracking. You don't want an income tax shock at the end of June. So it's good time to sit down with your numbers and annualize it to see how it's going to end up. And if you need to put some tax planning measures in place, sit down with your accountant in January.
Yes.
Sit down once you have done your taken stock, and when you have done your numbers and you realize, oh, this year is going to be a year of huge bonus, probably pay a huge amount of tax. So can I contribute additional into the super where I can save some tax? Any capital gain tax events happening. So these are the things which one needs to sort of sit down and plan for it, rather than reaching in June and realizing that they have missed the boat.
Certainly. And a big part of that is sort of asking ourselves what we want to achieve, right?
Yeah.
So we all run a different race at different paces. So, in this case, with all things not being equal, it's a matter of what can I do within my means. So you sort of look at it and you say, okay, we're now approaching the end of the year. This is how I've performed, or this is how my portfolio has performed. This is now my current income situation. Both positively and negatively, right? And I guess often we want to sort of paint a rosy picture and think everything sort of goes on an upward trajectory. But the reality is there are peaks and troughs, there are ups and downs. So if we are on track more or less, then it's a matter of what do I want to achieve in the year to come. So, and again, that takes, in order to do that, you need to take stock of your finances, your capacity to service and take on additional debt. And I guess when we're talking about capacity for additional debt and borrowing, so Sandeep, I guess as the expert in that space, what does that look like? And when you're having these conversations with people who are goal setting and building portfolios, what are some of the key things that you would be discussing with them?
Good question, George. And a typical client of ours will ideally sit down with us twice a year. We will have our annual planning meeting around the June end or early July, where people set their goals for the financial year. And good to sit down close to Christmas or just after Christmas to revisit and see how things have progressed. Say, for example, George came to us around July and we had a plan. We set our goal, as we said in our previous episode. These are the plans, acquiring a couple of properties in the next 2 years. So, and we set off with that goal in July, saying, George, you have to go and buy X amount of properties, say one property by December. Then we sit down and say, have we done it? If we have done it, how good was the purchase? What has happened since the purchase? If we have any past properties that we hold, performing the valuations of those properties and see if any equity is available, how the properties have grown. And then looking at the borrowing capacities to see if we can expedite any more purchases, or we have to, if things have changed in a job negatively,
Yes.
then how do we sustain what we have,
Yes.
so that we can sort of postpone our next purchase but still keep on track in the major scheme of things. So, and then comes those discussions around the lending policies changing and all that. This is a time where a few things have changed. We shall touch base before the end of the podcast today. But those are the things, checking your interest rates with the lenders, checking with equities available. These are the things we'll do for you. However, this is the time where we need to sit down with our clients and we need to think, are these things in order? If not, or if there is any opportunity to draw equity, is there any opportunity to sort of sit down with your accountant as well, along with us, to see what the accountant's thoughts on the tax saving methodology are, or tax saving opportunity are, and how can we plug into that in terms of the asset building.
Well said, Sandeep. And I guess we were touching earlier on the financial health check for us, I guess, as borrowers or individuals, right? Whether you're a PAYG type of employee or whether you're a business owner and you're self-employed. So doing that health check and performance check is important. But I guess as a good segue, when we're doing our review and our reflection on the year that's gone by, we also need to do a performance check or a temperature check of our portfolio, right? So ultimately, that's what we're here to sort of discuss. And the portfolio has two sides, like any balance sheet. So you've got your income and your expenditure side. So typically when I sit down with my clients who have portfolios and we're doing their review, we look at both the money coming in, but a lot of people tend to ignore the money going out. And that can make a lot of difference. So in terms of the money coming in, it's obviously sort of your rental income. Are you achieving market rent? When was the last time it was reviewed? And speaking to your property manager, you can get a very quick pulse check of whether these things are happening and whether you're on the right path.
Absolutely.
And if not, then you talk about a small plan on how do we get you to achieving market rent without displacing your tenant. And then obviously there's the expense side. So you've touched on things like interest rates and loan repayments. And then we look at things like insurances, holding costs, property management fees. And as far as repairs and maintenance goes, when we do a sense check at the end of the year, is the property costing you a lot in repairs and maintenance? And if so, is there a decision you need to make there? Or ultimately, is it more about tighter management? So it's very critical to be able to sort of look at that and go, well, the income's great, but then the expenses, how close am I keeping an eye on that?
Yeah, I agree with you, George. And when I say, when we recalibrate these things, whenever we forecast something for the next year or we go with a plan, nothing works 100% to what we are trying to achieve, right?
Yes.
So there will be a forecast error, and the forecast accuracy will depend on how close we are to the forecast. And that's where measurement is key. And as you rightly said, the insurances, making sure the insurances are right, not only on the properties and your vehicles and all, you are the biggest asset in this game.
Very true.
If one of my clients is taking on $2 or $3 million debt over 3 or 4 properties, that is when they need to realize and have to definitely ensure if anything was to happen to them. Life is uncertain. COVID has taught us that, right? So if something happens to you, am I adequately insured? A lot of people get an insurance 4 years ago and the asset position changes and their journey changes and their asset and liability position grows and the insurance is not revisited. That's why once a year, absolutely necessary to sit down with your financial planners, with your insurers. Guys, I'm 40 years old. Recently I had this health issue. I've got 4 properties. My debt is over $2 million. If I was not there, how would my family survive or how would the debt be looked after? So those are the things which one needs to really think of. And that is one of the most underestimated things which I've always seen. And people underestimate that.
Same with me. And it's quite remarkable because we typically enter a lot of debt and you need to do that, right, to be able to build a portfolio. So there's a lot of risk that you're carrying. And then you look at it and you go, well, how can I mitigate some of that risk? It's about insurances. And obviously you're talking about not just the asset, it's about personal insurance. And you do that in consult with obviously a financial advisor to make sure you get the right level of cover. But that asset protection space is absolutely critical because if something were to happen to me or to yourself, then you want to ensure that the rest of the family is in a position to withstand and not have to sort of sell everything down.
Agreed. Just avoid stress. You will not be there. So if one of the person is not there, the other or the remaining people in the family definitely should not go through those difficult situations.
Certainly. And I guess when we're talking about goal setting, the other element of it is education, right? So it's about educating ourselves. And I typically find the best way, and this feedback comes from clients as well. So the best way most investors educate themselves is by listening to other people in that space. So whether they're profound sort of mortgage brokers like yourself or buyer's agents, property experts, accountants, financial advisors. So these people who have been there and done it, they've built a bit of a roadmap for themselves. Listening to them helps us lift our level of understanding in this space and what we need to do.
Yes, and that is so important, George. Reading books, at least one good book every year, and listening to a podcast or two every week absolutely is a good way of keeping yourself updated. And at the end of the year, with all what we have read or listened to, what have you got out of that? Have we learned anything new? Have we discovered something that we don't know? So those are the things like learning, peer-to-peer learning, sitting down with us saying, hey, Mr. Broker, what's happening in the lending market at the moment? What are the new opportunities? And things are changing all the time. The government policies change, the government benefits change, lenders change the goalpost all the time. So if we had planned something in June and because of the changes in the lending, is it going to affect our next acquisition? absolutely important to understand, right?
Definitely, definitely. Because without that sort of understanding and that clear path, you can't really progress, can you?
No, and that's where taking stock 6 monthly and checking whether we are on track to our next goal is absolutely key, and that's where we come in, and we encourage every client to sit down with us and take stock of their personal situation.
Yeah, it really is key, Sandeep. It really is key. And going back to that education point for a moment as well, I tend to agree completely. I think it's very good to be able to sort of take in as many podcasts and white papers and things of that nature that you can. However, keep in mind, I guess we want to apply that to our own personal circumstances. So they say comparison is the thief of joy. So what we don't want to do is compare ourselves to the people who are on this podcast and who are publishing these papers, but it's more the education piece. It's, what can I take out of that as opposed to can I replicate what they've done? So it's about sort of understanding our limitations, but also knowing where we are and then setting a path forward.
Yes. And George, as you rightly said, you don't compare yourself to others who have achieved a lot or somebody who just got started. It is about comparing yourself to what I planned as a overall generational wealth building strategy, and how is this year, which is a small piece of that entire puzzle, how is this fitting in? Is it fitting in right? Because if this year doesn't fit in right, we need to change our plan going forward. We need to change course. It's just like driving. Like I have to reach from point A to point B and it takes 50 minutes, and because of traffic I have lost 30 minutes here. What's the plan going to be? So that's exactly how one needs to compare themselves to what they set to achieve.
Certainly, yeah. And what you're talking about there is very much, often we're told property is a set and figure type investment approach. And, with you and I guess, being so involved in this space and so engrossed in the space, we know that that's not the case, right? And I guess the crux of the discussion today is very much, it's not really set and forget. It may be sort of passive to some extent, but to your point, it requires adjustment. It requires a pulse check or a temperature check. You need to sort of follow that navigation. So if you are steering off path and you need to make an adjustment to course correct, then certainly those regular checks will make sure that you can do that and achieve it.
I agree with you. And I do not believe anything is passive income. You have to have some ownership of it.
Of course.
It's active business. To me, property investment is active business. I'm a mortgage broker. Mortgage broking is my business. However, my personal property portfolio is my business. I need to make sure that everything, what that asset was meant to do, is it doing it or not? Is it the time to recycle one of the assets? Like a lot of our clients, when they start their journey, they would start with buying an apartment because they are renting and they do not have a huge deposit. Now these first home buyer grants and all have opened up. However, there have been situations where clients have bought apartments, stopped renting, got their own place, paid down the loan a little bit. However, now they have upgraded. Is that asset to be replaced? Is a townhouse, that apartment, can that make way for a next investment property, which can be a house with some land portion? So not only gathering assets, but also recycling assets as and when they are required to do. So if that apartment has done its job, I think that's the time when you think, can this asset be replaced? What are the replacement costs? What are my tax implications when I do that?
Yeah, absolutely. I think it's a very good approach and quite a common one, because we all start somewhere and you can only build upwards, but you do need to start somewhere. So in a moment, Sandeep, we're obviously going to sort of get you to provide a bit of a update on what you're seeing over the last couple of weeks in terms of the lending landscape and any sort of major shifts. But before we do that, let's sum up on our planning and goal setting approach. So I guess the key takeaways are find a time over the course of a year. For most people like yourself and I, it's typically the end of the year, the December period, where things quieten down. So we do a bit of a pulse check of how we've tracked over the course of the year. And then we use the findings of that review to set our goals for the year ahead. So there's no right or wrong approach. And as you alluded to earlier, some shorter, quick checks over the course of the year, just make sure that we're on track, as opposed to setting your goals and then not looking at them again for 12 months. I think that's a great approach. And then when we try and identify what's changed and where we're going, we then sort of put some steps in to help us get there.
Yes. And again, can't stress more on the fact that sitting down with people like yourself, us, the accountants, the financial planners, for half an hour, 45 minutes, good enough.
Yes.
Before you do that, you do your numbers so that you have got the right questions to ask.
Yes. Preparation, right?
Absolutely.
Being well prepared certainly helps. And then just lastly, when we are doing those checks, the final thing we touched on is around looking at the income and the expense side of the equation, making sure that the income that's coming in is in line with market, but also your expenses and your holding costs are not blowing out. So that way it keeps you aligned and on track to achieve your next goal or your next step.
Absolutely. And the key point in building generational wealth is being, while you acquire the assets, being able to sustain it. And the cash flow changes, cost of living changes. Like a lot of expenses that have not been planned suddenly arise. So that's where one needs to take stock of the cash flow position. Absolutely important to make sure the balance sheet is right and it's not going to hinder them from acquiring the next asset.
That's very critical because there are things, as you've alluded to, that will come up outside of your control, and being able to sort of sustain the impact of those, whether it is an interest rate rise or an unforeseen expense in the property. We don't want those events to sort of wipe us out. We want to be able to sustain it. And that's really sort of a fundamental of being a good property investor, right? So it's not biting off more than you can chew, but it's sort of growing in a sustainable manner.
Yes.
Excellent. So Sandeep, let's move on to essentially a bit of an update, a pulse check on what you've been seeing in the lending space since we caught up last, please.
Yeah, George, lending space is, it's never a boring space there. It's interesting all the time. Things change, government policies, lending policies and whatnot. This last quarter of this current calendar year has been amazing, crazy in a positive way. As of 1st of October, the first home buyers opportunity, a lot of buyers can take benefit of that opportunity because of the income caps going out, because of the property price caps being pushed up.
Yes.
Also unlimited spots and all, which makes this space really busy. What has that done with a lot of lenders is they have slowed down a bit because of the number of applications. Because in this first home buyer scheme, not all the lenders are participating. These are the lenders which participating lenders are a few.
Okay.
That's where it becomes, it is really important for people before they go into their first home buying at 95% loan to value ratio. It's really important to sit down with us because the margin for error is really low. Mm-hmm. You only have 5% deposit. You don't want to bid at an auction and realize I paid a bit too much.
Yes.
So those are the things which we are seeing a lot. We are prepping people for their first home buyers acquisition a lot because that is the first acquisition, and after that person sets off on building the properties and assets, right? So that's one space. However, the second space, which has been quite interesting in the last month or so, has been company and trust lending.
There's a lot happening in that space.
Oh my God. Things have changed a lot. Macquarie came out and said, we'll stop lending to company and trust altogether. Then CBA last week said they will only lend to existing customers who have a lending facility for minimum 6 months. And that can even be a credit card. But the approach CBA have taken is really interesting, and it's a good approach where they want to understand the client better because before that that sort of high risk lending comes into play.
Yes.
Right. So, and what has that done? That's put pressure on the lenders who are still doing it.
Yes.
So the timelines have absolutely blown out for those types of deals.
Okay.
A lot of noise was there around unlimited borrowing capacities and all. And I personally don't believe there is something called unlimited borrowing capacity. It's responsible borrowing is also important. Lenders have that duty of responsible lending. Us have the best interest duty of the client to make sure the client is not getting into trouble because of this lending. But it's very important for people to understand responsible borrowing. And there is nothing called unlimited borrowing capacity.
No.
One needs, if I am borrowing the money through a company or a trust, I'm still responsible for that debt.
Certainly.
Right? And there is an asset attached to it.
Yes.
And people want to acquire more and more. However, they need to think, How's the cash flow? Can they sustain it? And if a lot of people I've seen them borrowing under companies and trusts when the interest rates were ultra low, that trust may be sustaining itself then. And then the interest rate price cycle started and interest rates increased by 3 or 4%.
Yes.
And the rents did not catch up that fast. That's where a lot of people got into trouble. Well, not a lot of people would have lost their properties, but they will have to recalibrate. That's where I think being very careful when borrowing is very important. So that is one key thing that has come out. A lot of lenders are repositioning themselves on the company and trust lending. It's not gone. It will still be there. I think lending solutions will always be there.
Just with some more checks and balances.
More checks and balances. And the last thing which was a good update was as of 1st of February 2026, APRA wants to keep a check on the high-risk lending. What does high-risk lending means is all the deposit-taking institutions cannot have more than 20% loans which are more than 6 DTI. When with DTI, what we mean is debt-to-income ratio. Mm-hmm. So realistically speaking, not more than 20% of your book should be more than 6 times debt-to-income ratio for a client.
Yes.
So what will that mean is the deposit-taking institutions will have to cut back on the lending where the DTI goes above 6. So debt-to-income ratio goes above 6.
So in practical terms, for instance, if in that scenario, someone has an income of, let's say, $200,000 for nice simple maths, then the maximum allowable debt would be 1.2 million.
1.2 million. So when with that income, your $100,000 salary plus $50,000 rent on another property and $50,000 rent on the other property. So that is the total income. So total income calculated based on all that money you earn.
Yeah, fantastic. It's an interesting space, that one. I did see that sort of coming through, but I wasn't quite well versed as to where it was going or how it was being driven. And just lastly, before we move into a bit of a market update, so you mentioned CBA's obviously sort of taken some steps to tighten up the process on the trust lending. If you were a betting man, would you expect the rest of the big four to follow?
Definitely things will change is what I believe. However, because these big banks or the second-tier banks, they do things one after the other. Like even when the RPA declares the interest rate decision, within a few hours, the majors will follow each other and declare whether they are going to pass it on or not.
Yes.
So definitely things will, that's an interesting space and we'll be watching it very closely because banks don't want to get caught into those situations where they are investigated for certain things. So I think it's a welcome move from Macquarie and CBA, I think, just to cut down on that high-risk lending. However, that lending space is still open and there are still options. With that one, and the next, the 6/6 debt-to-income ratio, there will still be financiers who are not deposit-taking institution who have their money warehouse in other markets.
Yes.
And that's where I think the lending options will still be there.
Yes.
There was a time where debt-to-income ratio of 8 was okay.
Mm-hmm.
Now, as of 1st of February, things are going to change. So that lending, which won't fit in with those lenders, would definitely fit somewhere else. So there will be options. So it will make people like us more valuable where you can't just walk into a bank and sort of after a certain point,
and get what you want. Absolutely. So no, thank you for that. It's very it seems to be quite a fluid time in that space. Obviously driven by affordability, housing prices. So the lenders are certainly sort of responding and trying to be more responsible, which is good to see for the consumer.
So George, with all these changes, what you see in key markets and how do you see the 2025 finishing and what to expect around 2026?
Yeah. So in terms of the 5% deposit you touched on, so certainly seeing the impact of that with more and more people coming into the market to buy their first home.
In that price bracket.
In that price bracket, but it's also putting some pressure on the price, right? And I don't know if it's entirely serving the audience that it was designed to. So, and by that I mean people who have got larger deposits, but for whatever reason have not entered the market as first home buyers, are now sort of using that as a bit of a confidence boost to dive right in. So we are seeing that pressure point in terms of price as a result of this incentive. So aside from that, in terms of various markets across the country that we're active in at the moment, so in terms of parts of Queensland, still a lot of strong activity leading up to this point. Now, in terms of assets coming to market or stock coming to market, people selling their property this side of the break, that is starting to slow down. So there are some markets across basically the entire eastern seaboard where we operate, where ultimately vendors are not driven by a timeline by which they need to sell. Then the messaging from their sales agent is let's hold off. People are away, the buyer pool is half present. Then let's essentially bring your property to market in that last week of January.
Around that Australia Day mark.
Around that mark there. So I know a number of agencies are already sort of flagging Super Saturdays for late January.
Wow, Super Saturdays.
Super Saturdays. So that would be sort of the first auction weekend for a 4 or 5 week period for some. So it's very much a case of if you don't need to sell, the messaging is let's hold off until the new year. And for me, I guess from my vantage point, that does make some things challenging in terms of finding investment grade assets for clients where we're looking at. So predominantly even places like the Central Coast, there are properties coming to market, but it has been a challenge for a little while. So it's something that we would navigate. And then certainly sort of across Sydney as well, that seems to be the case. As far as going back to Queensland for a moment, so places like Moreton Bay, Toowoomba, again, low quality and low supply at the moment. So it is making that sort of process challenging. We are transacting, so there are still sort of good quality assets. We're getting access to some pre-markets to say that we've now signed on this particular client who wants to sell their property. They're open to doing it in the new year, but if essentially there's a compelling enough fit, then they are willing to transact.
So would it be fair to say, George, it's really difficult to source real good assets at the moment given the pressures due to various factors in the market? You would have found it easier to source an asset around March, April time than now?
Oh, certainly. I mean, even a few months ago, so when we're in essentially the full swing of the calendar year and people are moving, they're making their decisions, there's no line in the sand, but now, Christmas being several weeks away, and that's kind of been the case, for the last sort of fortnight, maybe 2 to 4 weeks. We've had that sort of one eye on Christmas, one eye on the new year, and people are looking at that going, well, do I do this now or do I wait until the new year? And it's not just property type of things, but in this context, certainly the case.
Great. And George, how have you seen Victoria doing in the last few months? Because we are hearing some really positive things in Victoria. And secondly, before we go, the Maitland and the Hunter Valley markets. What are your thoughts there? Because we've seen some significant activity there.
Yeah, likewise. So in terms of Victoria first, the way we position that when we speak with clients is very much sort of an early adopter market. We are seeing some growth movement already in some markets. There are some areas that largely transact off market in Victoria, in Greater Melbourne. So places like Werribee, for example, where clients have a budget of, let's say, 700 to 750K, and they want to buy something with quite a large land holding. There are older sections of Werribee, older parts of the Werribee area where you can enter the market at that price point. With that said, a lot of it transacts pre-market or off-market. But again, careful due diligence is needed, and that asset selection is very, very critical just to ensure that you buy something that's aligned to your goals. The rest of Victoria, again, there's a lot of activity. And the reason we call it an early adopter market is at times clients who are listening to podcasts and consuming content from social media rightly or wrongly have a expectation of immediate results. They want to see an uptick in 6 to 12 months. And typically we invest in property over the long term. So Victoria, long-term investment certainly has, it's a market that we're actively buying in for clients. And then you touched on Maitland, the Hunter region, Newcastle. Again, fantastic market for people with more of a modest budget. We are seeing, again, opportunities where you get a larger land holding. The asset itself is slightly older, may need a little bit of upkeep, but in terms of growth prospects and rental return, they're still quite attractive markets to be buying in. We're quite active in those areas at the moment for clients also.
Fantastic. And regional centres around Queensland and Victoria, any thoughts there?
So Bendigo and Ballarat. So we're not buying too much in those areas at this point. So some of those markets over the last sort of 12 months have seen a negative growth. But again, if the timeline horizon is long term, then it's certainly an attractive proposition. Same with places like Geelong. Frankston has been quite good. So Frankston is actually sort of growing, which is kind of the anomaly there, and with a slightly sort of higher price point. So, there's 750 and up budget, then certainly sub 1 million. Then we're looking at sort of places like Frankston North for those clients. In terms of Queensland regional markets, so places, about 18 months ago, we were buying in places like Rockhampton. That's quite sort of slowed down for us as a business at the moment. Townsville has been sort of a popular area, of course, as we all know, for the last several years. I still expect that there's a bit of growth left in Townsville because the growth is quite strong, especially over the last 12 months. We're talking sort of upwards of 15 to 22% in some suburbs. So we expect that to continue and then eventually sort of taper off and regress to the mean. And then Toowoomba as well. So being a strong regional hub, there are some opportunities in Toowoomba. Again, that's been a market we've been buying in some time, but we're quite bullish on places like sort of Toowoomba and Moreton Bay as well.
Which are closer to the Brisbane
absolutely
suburbs.
Absolutely. They're not far off at all. Toowoomba is a strategic sort of hub as far as sort of
it's got its own economy as such.
Absolutely. And it's quite a large economy. And same with Moreton Bay. It's in close proximity to Brisbane. So we're typically quite bullish on these areas.
Fantastic. So, George, that brings us to a close of this episode. And before we go, I think we need to talk about what we'll bring next time and wish everyone a Merry Christmas and Happy New Year. So a Merry Christmas and Happy New Year to you, George, and to our audience too.
Thank you, Sandeep. A Merry Christmas to you as well. And I look forward to chatting to you about lending when we catch up next.
Yes. So next episode we bring will be about, now that we've taken stock at December, will be the New Year resolutions and how things need to put in action. So that's what we'll probably talk about in the next one. So see you next time, George.
See you, Sandeep. Look forward to it.
Thank you for listening to this one. Thank you.